how is Powell going to cut rates if inflation is 4 or 5 and headed higher? How does he do that? Well, he can't, but he's going to have to, which is why there's going to be a currency crisis, a US dollar crisis, and why I'm so bullish on gold.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The core number has been higher than the headline number because of the negative effects of falling oil prices. Well, that's been reversed. I mean, oil actually was slightly down on the week. I had thought that we would have a bigger up week with some momentum. Instead, we got some profit taken. We did make a new high. Oil prices got above 84, which was a new high for this move. And they ended up selling off a bit. We closed around 82.5 or so, just off about 20 or 30 cents on the week. But if you look at where oil prices are since the July CPI came out, if you look at what happened, in the last month, right? Oil prices are up like another 15%. So that's going to have to show up in the August CPI number. We're going to have to start seeing the impact of rising energy prices, which is why I think that we've probably troughed here on these improving CPI numbers. And now we're just heading the other way. But again, even ex-food and energy, we're at 4.7. If that's the preferred measure, if the Fed just ignores the headline, which is what it always says when the headline is higher, because you got food and energy prices going up and they want to focus on the core. If the core is only at 4.7, that's all they've accomplished. Moving rates from 0 to 5.25, they've only managed to bring core CPI year over year to 4.7. That's it. They want to go all the way back down to 2. They don't have a chance because, again, they don't have much left in the way of rate hikes. And we're already kind of bottoming out because they've got no help whatsoever from Congress, the president. There's been no cuts to government spending. They're increasing government spending, and the deficits are increasing to finance it, which ultimately puts tremendous pressure on the Fed to end its quantitative tightening and return to quantitative easing. Just a question of when does the Fed blink? They already blinked once with the bailouts of the banks, and they're probably going to need another bailout soon enough. So even though they have been shrinking the balance sheet, I expect that process to reverse. In fact, I think that before the Fed starts cutting rates, they're going to be expanding the balance sheet again. A lot of people are thinking that, the Fed's going to start cutting rates while they continue to to shrink the balance sheet. I think it's more likely that what stops first is the balance sheet, that they're going to reverse that before they start cutting rates. But they are going to have to cut rates because the government is going to need the help, because the government can't afford to pay the interest on the national debt. And when it becomes a big enough problem, then the Fed is going to provide some relief, which is going to just, send inflation numbers much, much higher. Let me get to the PPI numbers that came out on Friday, though, because these, I guess, were looking a little bit better on a year-over-year basis. But again, I am expecting much bigger increases in producer prices. They're going to be affected by the increasing energy prices, the increasing transportation prices. Everything is going up. So the consensus was for an increase of 0.2 for July, and we actually beat it. We were up by 0.3. So the inflation number on the producer front anyway was a little bit higher than expected. And the same thing with the year over year. It was supposed to go up 0.7. Instead, it went up 0.8. But the bigger news is the difference between the prior month, because the June number was up just 0.1, although that was revised to up 0.2. But we've gone from up 0.2 to up 0.8. That's the wrong direction, right? It's supposed to be going down, and now it's going up. Ex food and energy, the core was up 0.3. Again, that was also a bigger increase than was expected, which was up 0.2. Now, that was hotter than the prior month. That was actually revised from up 0.1 to negative 0.1. But again, that's a move in the wrong direction, from a decline of 0.1 to a rise of 0.3. And year over year, ex food and energy, it's up 2.4. Again, above consensus of up 2.3. It's equal to the prior month, but there's no more improvement. Maybe nobody is bothering to notice this, but they're talking about all the improvements. Those improvements are in the rearview mirror. What we're looking at in the windshield is pretty scary when it comes to future inflation. All you got to do is open your eyes to see all those pressures there. But people seem to be blind to that. And not only do we keep getting these bad news, bad numbers on inflation, but we continue to get other numbers that evidence a weak economy. Now, I was looking at the consumer credit numbers, which jumped again on the week, 17.9 billion. They were looking for a 14 billion increase. We got almost 18 billion. And the prior month was revised up from 7.3 to 9.4. One of the drivers was a big jump in credit card debt. Credit card debt in America is now over $1 trillion. That's never happened before, that we've had $1 trillion of credit card debt. We're approaching $2 trillion of student loan debt. I mean, that is astronomical, but we've never had over $1 trillion in credit card debt. Why are Americans relying so heavily on their credit cards? Because they can't afford to buy stuff with the money that they have. So they have to borrow money they don't have. Wages might be going up, but they're not going up as fast as other prices. And so people have to rely on credit. But that's part of the problem, because inflation is not just an increase in the supply of money, but it's also credit, because you can use credit instead of money. So if you can buy stuff with credit, you can bid up prices. And that's what's happening. Because consumers still have access to a lot of credit, they're able to use that credit to keep buying stuff. Now, if they didn't have access to that credit, well, maybe they'd have to stop buying, right? And so the interest rates would have a bigger impact on inflation, because they would be reducing demand, because people wouldn't be able to borrow the money. But if they're borrowing it anyway, even though interest rates have gone up, they keep on borrowing, then you're not getting the reduction in demand. It's just there. And of course, the government hasn't reduced its demand at all, right? It hasn't shrunk its spending, because all that is driving consumption and pushing prices higher. Also, I mean, I don't want to diminish the loss of life, but look at the fires in Maui, in Lahaina, just decimated, thousands of homes destroyed. Who knows how many people lost their lives? I know there's like 1,000 people that are missing. I'm not sure. I think they have maybe 60 confirmed dead. It's a terrible disaster in Maui. But think about how that kind of disaster, how that impacts what's going to be going on in prices, because all these homes that were there, now they got to be rebuilt. Where's the raw materials going to come to reconstruct them? All these insurance companies have to pay for this. Where are they going to get the money? They got to sell bonds. If they were holding on to those, bonds didn't correct. Bonds got clobbered again on the day and on the week. We closed, I think, at new highs, weekly highs. The yield on a 5-year is 4.272. 5-year is 4.272. A 30-year, that is, excuse me, the 5-year closed at 4.308. Kind of, with the yield curve was inverting a bit, but that changed. Now the 5-year is once again higher than the 10-year and the 30-year. So the 5-year closed at 4.308. The 10-year is 4.168. and the 30-year at 4.272. But all these yields are higher than they were previously. And I guess maybe those inflation numbers that were a little bit worse than expected sent the yield on the 5-year higher, because maybe people think that we're going to see an extra rate hike maybe in September. I don't know what, but you got that movement. In fact, the stock market was down on the week, all but the Dow. The Dow was the only index that was positive. The NASDAQ, by the way, has now dropped for 2 weeks in a row. That's the first time that's happened this year. A lot of people might not have realized that. We haven't had 2 back-to-back declines in the NASDAQ until this last week. And so again, I've been talking on this podcast, the market should be going down based solely on this backup in interest rates, which has continued. And as far as I'm concerned, looking at the charts, there is no evidence that this is going to stop. I mean, I think rates are going to be moving up towards 5% on these maturities before the end of the year. And that is a huge negative milestone that should be a massive roadblock for the stock market. But we got, consumers are struggling. They're going deeper in the debt. The savings rate is plunging. I got some other economic data that I wanted to talk about. Yeah, the jobless claims, they spiked up again last week. They were up 21,000. They went from 229,000 in the prior week to 248,000. Now, I don't know when the 30,000 people who lost their jobs from yellow, when they're going to show up in these numbers, but that's coming. But so you're getting the pickup in unemployment. In fact, what a lot of people just don't seem to get is that when the economy officially goes into recession, I mean, I've been arguing that it's been unofficially in recession for quite some time. But when we officially get into recession, when we finally get a big enough increase in joblessness that it shows up in the statistics, when that happens, the inflation numbers are going to be going in the other direction. So everybody is expecting that, well, we're not going to have, we're going to have a soft landing, or we're not going to land at all. But if we end up in a recession, everybody just assumes, well, then the Fed is going to be able to cut rates, right? Because the economy is going to need stimulus. Well, how do they do that if inflation is moving back up in the other direction? I mean, Powell said at the last press conference that he expects rates to be cut. He expects the Fed to cut rates long before inflation gets back to 2%. But when he said that, it's probably with the expectation that inflation will at least be headed in that direction. That maybe it'll be, 2.5, 2.4, like kind of on a glide path to 2%, and then they'll start cutting rates. But how is Powell going to cut rates if inflation is 4 or 5 and headed higher? How does he do that? Well, he can't, but he's going to have to, which is why there's going to be a currency crisis, a US dollar crisis, and why I'm so bullish on gold.